The financial landscape heading into 2025 is not about chasing hype, viral trends, or speculative assets. It is about building durable, low-maintenance portfolios that survive volatility and compound over time. For the average investor, someone without a finance degree, a Wall Street job, or hours to spend analyzing charts, the priority must be simplicity, automation, and risk control. That means avoiding emotional decisions, ignoring influencer noise, and sticking to globally proven frameworks that have worked across decades and economic cycles. The goal is not to get rich quick. It is to avoid getting poor slowly, and then let time, discipline, and compounding do the heavy lifting. In 2025, inflation may still be lingering above pre-pandemic norms. Interest rates will likely remain higher than the near-zero era of 2010 to 2020, and geopolitical instability continues to create uncertainty in global markets. These conditions demand a portfolio that is resilient, not aggressive. That starts with asset allocation, not stock picking. Most individuals waste energy trying to find the next Amazon when they should be asking, what percentage of my money should be in stocks, bonds, and cash right now? The answer depends on your age, goals, and tolerance for loss, not on what is trending on TikTok. Index funds and ETFs remain the most rational starting point for 95% of investors. Why? Because they offer instant diversification, ultra-low fees, and exposure to entire markets without requiring you to predict winners or losers. Trying to beat the market by picking individual stocks is statistically a losing game. Even professional fund managers underperform the S&P 500 over 10-year periods more than 80% of the time. In 2025, with AI-driven trading, algorithmic volatility, and global macro shocks, that gap will only widen. Passive investing is not boring, it is brutally efficient. Your emergency fund is not an optional step. It is the foundation. Before you invest a single dollar in the market, you need 3 to 6 months of living expenses in a high-yield savings account or short-term treasury bills. Why? Because life happens, job loss, medical emergencies, car repairs, and if you are forced to sell investments during a downturn to cover bills, you lock in losses and derail your entire strategy. In 2025, with potential layoffs in tech, real estate, and even AI-impacted sectors, liquidity is not a luxury, it is insurance. Tax efficiency is not just for the wealthy. Where you hold your investments matters as much as what you invest in. Retirement accounts like IRAs or 401ks in the United States, or equivalent tax-advantaged wrappers in other countries, should be maxed out before you invest in taxable brokerage accounts. Why? Because compounding works best when it is uninterrupted by annual tax drag. A 1% difference in net returns due to taxes can cost you 6 figures over 30 years. In 2025, with potential tax code changes looming, optimizing your account structure is more critical than ever. Automate everything. Set up recurring deposits into your investment accounts, automatic rebalancing, and dividend reinvestment. Human behavior is the enemy of long-term returns. We buy high when we are excited and sell low when we are scared. Automation removes emotion from the equation. In 2025, with constant media panic over elections, wars, recessions, and AI disruptions, the ability to ignore the noise and stick to your plan will be your greatest advantage. Systems beat willpower every time. Avoid thematic investing unless you fully understand the risks. AI stocks, green energy, metaverse plays. These are not strategies, they are narratives. Narratives attract attention, but they also attract bubbles. Most thematic ETFs underperform broad market indices within 3 years because they are overcrowded, expensive, and prone to mean reversion. In 2025, instead of betting on a single trend, bet on the entire global economy through a low-cost world stock ETF. You will capture innovation without gambling on which company survives. Rebalance annually, not emotionally. Your portfolio will drift as markets move. Stocks surge, your allocation to equities grows, increasing your risk. Bonds rally, you become too conservative. Rebalancing once a year, selling what is overweight, buying what is underweight, forces you to buy low and sell high systematically. It is the opposite of what most investors do instinctively. In 2025, with potential market swings driven by rate cuts, elections, or black swan events, disciplined rebalancing is your built-in risk management tool. Ignore financial media. CNBC, Bloomberg, YouTube finance gurus, their business model depends on your anxiety. They profit from clicks, not your returns. Watching daily market commentary is like checking your weight every hour while on a diet. It creates stress without adding value. In 2025, turn off notifications, unsubscribe from panic-inducing newsletters, and check your portfolio quarterly, not daily. Time in the market beats timing the market, and peace of mind beats performance chasing. Finally, define your why. Investing without a goal is like driving without a destination. Are you saving for retirement, a home, financial independence? Your goal determines your timeline, your risk tolerance, and your asset allocation. In 2025, with rising living costs and uncertain job markets, clarity of purpose will keep you anchored. Write down your goal. Calculate how much you need. Reverse engineer your monthly contributions. Then automate, ignore the noise, and let compounding work. Quietly, relentlessly, and without drama. Asset allocation, how you divide your money between stocks, bonds, cash, and alternatives, is the single most important driver of your long-term returns and risk level. Not stock picking, not market timing, not crypto bets. Study after study confirms that over 90% of portfolio performance variability is explained by asset allocation alone. In 2025, with markets facing crosscurrents of inflation, rate uncertainty, and geopolitical risk, getting this right is non-negotiable. Forget the noise. Focus here first. The classic 100 minus your age rule for stock allocation is outdated. In 2025, people are living longer, working later, and needing portfolios that last 30-plus years in retirement. A 60-year-old might still need 60 to 70% in stocks, not 40%. Why? Because bonds alone will not outpace inflation over decades. The key is not to avoid risk. It is to calibrate risk to your actual time horizon. If you will not need the money for 20 years, you can afford to ride out volatility. If you need it in 2 years, you should not be in stocks at all. Global diversification is not optional. The United States stock market has dominated returns for the past 15 years, but history shows leadership rotates. In 2025, emerging markets, Europe, and Japan may offer better valuations and growth potential. A globally diversified equity portfolio, say 60% United States, 40% international, reduces concentration risk and captures growth wherever it occurs. Currency fluctuations? They average out over time. Political instability? Diversification is your hedge. Do not bet your future on one country's economy. Bonds are not dead, they are different. With yields higher than they have been in 15 years, bonds in 2025 offer real income and genuine diversification. When stocks crash, high-quality bonds often rise. That is their job. Do not chase junk bonds or bond alternatives for yield. Stick to short to intermediate term treasuries or investment-grade corporate bonds. Their purpose is not to get rich. It is to reduce portfolio volatility and provide dry powder to rebalance into stocks during downturns. Cash is not trash. In 2025, with money market funds and treasury bills yielding 4 to 5%, holding cash is a strategic tool, not a failure. Use it for your emergency fund, short-term goals, or as a buffer during uncertain times. The opportunity cost of holding cash is lower now than it was in 2020. And psychologically, knowing you have a cash cushion reduces the urge to panic sell during corrections. Cash is not an investment, it is optionality. Alternative assets, real estate, commodities, gold, private equity, should play a minor role, if any, for most investors. They are illiquid, expensive, tax inefficient, and often redundant. A globally diversified stock and bond portfolio already includes exposure to real estate via REITs, commodities via mining and energy companies, and inflation via equities. In 2025, unless you have specific expertise or a very large portfolio, alternatives add complexity without commensurate benefit. Your risk tolerance is not what you think it is what you prove in a bear market. Everyone says they can handle a 30% drop until it happens. That is why you must stress test your allocation before the storm hits. Use historical scenarios. If my portfolio dropped 40% tomorrow, would I sell or buy more? If the answer is sell, You are too aggressive. Adjust now, not in panic. In 2025, with potential for sharp corrections, alignment between your allocation and your true emotional capacity is survival. Rebalancing bands matter. Instead of rebalancing on a fixed date, consider rebalancing when your allocation drifts beyond a threshold, say, plus or minus 5% from target. This reduces unnecessary trading and taxes while keeping risk in check. In volatile 2025 markets, this method is more efficient than calendar-based rebalancing. It forces you to trim winners and add to losers, the exact behavior that generates long-term outperformance. Tax location is part of asset allocation. Place tax-inefficient assets like bonds or REITs in tax-advantaged accounts. Place tax-efficient assets like index funds in taxable accounts. This simple step can add 0.5% to 1% to your annual returns over decades. In 2025, with potential tax hikes on capital gains or dividends, optimizing where you hold each asset class is a silent performance booster most investors ignore. Asset allocation is not set and forget. It is set and adjust. Life changes. Goals shift. Markets evolve. Review your allocation every 12 to 18 months, not to chase performance, but to ensure it still matches your timeline, risk capacity, and financial reality. In 2025, with rapid technological and economic change, flexibility is key. Your portfolio should reflect your life, not a static formula from a textbook. Stock picking is a losing game for 99% of individual investors, and in 2025 it is an even worse bet. Why? Because markets are more efficient, information is faster, and institutional players with AI, supercomputers, and insider networks dominate price discovery. Retail investors are the last to know, the last to act, and the first to panic. The data is clear. Over 10-year periods, more than 80% of active stock pickers, including professionals, underperform low-cost index funds. If pros cannot do it consistently, what makes you think you can? Crypto is not an investment, it is speculation. In 2025, despite the hype, crypto still lacks intrinsic cash flows, regulatory clarity, and consistent correlation with economic growth. Prices are driven by sentiment, liquidity, and narrative, not fundamentals. That does not mean it cannot go up. It means you cannot value it, predict it, or rely on it. If you allocate to crypto, treat it like a lottery ticket. 1 to 5% of your portfolio max, money you can afford to lose entirely, and never as a core holding. Hot tips from social media, podcasts, or friends are poison. They arrive after the move has already happened, when risk is highest and reward lowest. By the time a stock or coin is everyone's talking about it, the easy money is gone, and the downside risk is elevated. In 2025, with AI-generated content flooding platforms and influencers monetizing FOMO, the signal-to-noise ratio is worse than ever. If it is trending, avoid it. Real investing does not go viral. Concentrated positions are dangerous. Holding 30% of your net worth in your employer's stock, one sure-thing tech stock, or a single crypto asset is not confidence. It is recklessness. Diversification exists because the future is unknown. In 2025, disruption is accelerating. Today's winner can be tomorrow's bankruptcy. Spread your bets. Own hundreds or thousands of companies via ETFs. Let the market decide winners, not your gut. Fees and taxes will silently destroy your returns. Active funds charge 1 to 2% per year. Frequent trading generates commissions and short-term capital gains taxed at higher rates. Over 30 years, a 1% fee difference can cost you half your potential wealth. In 2025, with tighter margins and lower expected returns, minimizing costs is not optional, it is essential. Choose ETFs with expense ratios under 0.10%. Trade rarely. Hold for decades. Let compounding work. Undisturbed. Emotional investing is the silent killer. You buy when you are excited at peaks. You sell when you are scared at bottoms. This behavior gap, the difference between fund returns and investor returns, costs the average person 2 to 4% per year. In 2025, with 24/7 news cycles and algorithmic doom-scrolling, emotional discipline is your rarest and most valuable skill. Automate. Walk away. Check your portfolio quarterly, not hourly. Past performance is not just no guarantee of future results. It is often a trap. Stocks or sectors that crushed it last year are statistically more likely to underperform next year. Mean reversion is real. In 2025, resist the urge to pile into last year's winners. Instead, rebalance into what has been left behind. Boring, unloved, low-valuation assets often deliver the best long-term returns, precisely because no one is talking about them. Your time is worth more than alpha. Even if you could beat the market by 2% per year, which is unlikely, is it worth 10 hours a week of research, stress, and screen staring? For most people, that time is better spent earning more income, building skills, spending with family, or simply enjoying life. In 2025, the highest ROI activity for most investors is not stock picking. It is increasing their savings rate. The market does not care about your opinion. It does not care that you did your research or believe in the team. Prices are set by millions of participants with better information, faster tools, and zero emotion. In 2025, humility is your greatest asset. Admit you cannot predict the future. Admit you do not know what is coming. Admit that indexing, owning the entire market, is not settling. It is winning by not losing. If you still insist on picking stocks in 2025, treat it as entertainment, not investing. Set aside a fun money account, 5% of your portfolio max, and go wild. Track it separately. Never add emotional weight to it. And never, ever let it distract you from your core, diversified, automated portfolio. The goal is not to strike it rich. The goal is to sleep well at night, while your real portfolio grows quietly in the background. Before you do anything else in 2025, run this final checklist. Do you have an emergency fund? Is your asset allocation aligned with your goals and risk tolerance? Are you using low-cost, diversified ETFs? Is your portfolio automated? Are you maxing out tax-advantaged accounts? Are you ignoring financial media? If you answered no to any of these, fix that first, before chasing returns, crypto, or hot stocks. Discipline beats genius in investing every time. Your 2025 action plan is simple. 1. Calculate your target allocation based on your timeline, not your emotions. 2. Open or fund your brokerage and retirement accounts. 3. Set up automatic deposits, even if it is $50 per week. 4. Buy your core holdings, global stock ETF, bond ETF, cash equivalent. 5. Set calendar reminders to rebalance annually. 6. Delete finance apps from your phone. 7. Unsubscribe from market newsletters. 8. Review progress once per quarter, no more. That is it. No complexity. No drama. Just execution. If you are self-employed or a freelancer, prioritize setting up a solo 401k or SEP IRA. Contribution limits are higher than standard IRAs, and the tax benefits are massive. In 2025, with rising healthcare and tax costs, sheltering income is not optional, it is survival. Automate contributions from every invoice. Treat it like a non-negotiable business expense. Your future self will thank you profusely. If you have debt, prioritize high-interest debt, credit cards, personal loans above 7% before investing. Paying off 15% debt is a guaranteed 15% return, better than any stock market prediction. Lower interest debt, mortgages, student loans below 5%, can coexist with investing, but run the numbers. In 2025, with potential rate cuts, refinancing may be an option. Do not guess, calculate. Use online debt versus investing calculators. Let math decide. Teach someone else what you have learned. Explaining these principles to a friend, child, or colleague reinforces your own discipline and creates accountability. Most people never learn this stuff, they learn it too late. In 2025, financial literacy is a superpower. Share it, not to show off, to lift others up. The more people who invest rationally, the more stable the system becomes for everyone. Track your net worth quarterly, not your portfolio daily. Net worth includes cash, investments, property minus debt. It is the only metric that matters. Watching it grow slowly, steadily, is the ultimate motivation. In 2025, with so much noise about getting rich quick, Remembering that wealth is built in silence, over decades, will keep you grounded. You are not behind. You are compounding. If you change jobs, do not leave your 401k behind, roll it over to an IRA. Fees are usually lower, investment options are broader, and control is in your hands. In 2025, with increased job mobility and gig work, managing your retirement accounts proactively is non-negotiable. Set a reminder. Every time you switch jobs, handle the rollover within 60 days. Do not let inertia cost you thousands in fees or lost growth. Review beneficiaries on all accounts annually. Life changes, marriages, divorces, births, deaths. If your ex-spouse is still listed as your IRA beneficiary, your estate plan is broken. In 2025, with digital assets and complex family structures, updating beneficiaries takes 10 minutes, but can prevent years of legal chaos. Do it now. Do not wait for someday. You do not need permission to start. You do not need to be rich. You do not need to know everything. Start with $25. Start today. The greatest enemy of wealth is delay. In 2025, the best time to plant a tree was 20 years ago. The second best time is now. Open the account. Make the transfer. Buy the ETF. Automate it. Then walk away. That is how ordinary people build extraordinary results, without genius, without luck, without stress. If this script helped you cut through the noise and build a realistic, no BS investing plan for 2025, do me a favor. Like this video, subscribe for more rational financial content, and comment below with your #1 investing question for 2025. I will answer the top ones in the next video. Share this with someone who is tired of hype and ready to build real wealth. Slowly, steadily, and without drama. See you in the next one.